Well, today we're fortunate enough to have Ellen Brown with us, and Ellen is a big proponent of public banking. Ellen, will you tell us a bit about yourself?
I am the founder of the Public Banking Institute. I'm an author, I'm an attorney. I've written 12 books, but my two books on finance are called Web of Debt and The Public Bank Solution. I started writing about the Bank of North Dakota and how it allowed North Dakota to escape the credit crisis after 2008, and I got flooded with email, and we wound up forming an institute, and now we have 20 states with bills of one sort or another for state-owned banks, including California, which has probably gotten the farthest. But California had a bill that passed both houses of the legislature, and Jerry Brown wouldn't sign it. He said, we have plenty of committees, we don't need another committee. This was a bill for a feasibility study, and that they would do it in-house. But that was 2.5 years ago, and we haven't heard any more about it. So I have decided to run for state treasurer, which I am doing now on the endorsement of the Green Party.
Well, great. Can you tell us what public banking is?
A public bank, some people think that means a bank that's listed on the stock market, but what we mean is a bank that's owned by the people, owned by the government. We only have one in this country of the model that we're talking about, and that's the Bank of North Dakota. In 1919, the North Dakotans decided they wanted to break free of their subservience to Wall Street, so they pulled their money out of the Wall Street banks, put it in their own Bank of North Dakota, and they've been using their revenues and deposits, leveraging them into credit, as all banks do, for the last 100 years, and have done remarkably well with it, generating credit for the local economy.
So I hear a lot of talk about gold and fractional reserve. Does that have anything to do with public banking in North Dakota?
Today, all our money is created by banks on their books. At one time, money was supposed to be gold. People thought it was gold, but banks were allowed to issue bank notes, which were promissory notes for the gold. So people would leave their gold with the bank, and they would get this little promissory note acknowledging, or a receipt acknowledging that they had left it and that they could get it back on demand. And then the banks discovered that they could lend these notes out at many times in many multiples of the gold that they actually had. So that was the origin of what is called fractional reserve banking, meaning that the actual gold that the bank had was only a fraction of the notes that had a claim on the gold. So it was basically a fraud, and I think on average, every 7 years throughout the 19th century, there was a run on the banks when people would demand their gold when they realized that the bank might be shaky and didn't have enough gold. And so to fix that, we got the Federal Reserve in 1913. There was a particularly bad bank panic in 1907, and some big bankers got together. J.P. Morgan and Rockefeller and their cronies got together and pushed through this legislation for the Federal Reserve, which would backstop the banks, so that the banks, instead of having to borrow from J.P. Morgan, who got the money from England, probably from the Rothschilds, they would be able to borrow directly from the Federal Reserve, which would have the power to create money on its books. So that's what we have now. That did not backstop the banking system very well. It didn't prevent panics, because we had the worst panic we ever had in 1929. But then in 1933, we went off the gold standard, and ever since we have a currency that's backed only by the full faith and credit of the United States. But this currency is issued by banks. It's the same deal. It was the same system that we had in the 19th century, where banks would issue their own banknotes or issue their own credit. Only now it's not backed by gold, it's just the credit of the bank. In fact, the Bank of England admitted this in March. They came out with their quarterly bulletin, they said, contrary to popular belief, banks do not lend the money of their depositors. They actually create the money they lend on their books. So they do it by double entry bookkeeping. So all banks do that. So with a public bank, we want the power to create credit on the books for the people themselves. We want the profits to go back to the people. So basically all of our money today is credit. It's all credit and debt. It's all bank credit. Credits and debits. It's like a great big community currency system where people create the credit themselves by taking out a loan. But right now, the system we have has this great parasite on it that's just drawing interest and fees off for the privilege of using our own credit. So with a public bank, it will be our own credit. It's the credit other people use for the benefit of the people, and the profits go back to the people, and the purposes for which the credit is issued support the local economy rather than being gambled away in derivatives and other speculative ventures of the big Wall Street banks.
Okay, now somehow the banks let us think that they were lending the depositors money, right?
Right. That's what they teach you in school, that you deposit your money. I mean, that was what we saw in It's a Wonderful Life with Jimmy Stewart,
Yeah.
where he explained to his neighbors that Mr. Smith had the money because he was using it for his house, and that's why there wasn't enough money to go around. And that is the way the old savings and loans worked, and the savings and loans went bankrupt in the 1980s because that system didn't work very well. The problem was they would have these 30-year loans at 5%, and then the interest rate went up to 20%. They couldn't borrow to sustain this 30-year loan. So then we got into securitization. Anyway, today, the way banks create credit, or the way banks make loans, is that when you go to the bank to take out a loan, they do it by double entry bookkeeping. So they will write your promise to pay. Let's say you've agreed to pay $200,000 over 30 years. They'll write that on one side of their books as an asset to themselves because they'll be receiving that money over time. And they'll write the same $200,000 on the other side of their books as a liability to themselves because they will have to cover that check when you write the $200,000 check to the seller of the property. So at the bottom, it comes out to zero, and they say they haven't really created anything, that they've just issued credit. But your $200,000 check will then get deposited into another bank, which will call it a deposit, which can then issue credit against, well, they use the deposits for liquidity, so they balance their books with that, so they're able to issue more credit, and then so that money filters through the economy and it expands, and that's where our circulating money supply comes from. So it's kind of, you could see it both ways. In a way, you are lending the deposits, but the bank doesn't need the deposits till after they make the loan. They only use the deposits to clear the checks. In other words, to balance their books. They have to pull that money from somewhere. When your bank writes the $200,000, or you write the $200,000 check to your seller and it goes into another bank, your bank will pull that money will be pulled from its reserve account with the Federal Reserve, $200,000. So then it will have to come up with $200,000 some way. And ideally it would have deposits, and it will pull from its own depositors because that's the cheapest way for it to get money. But if it doesn't have sufficient deposits, then it can borrow from the other banks. It could borrow from the very bank that your check just went into, which is a form of check kiting, where they create the money, it goes into another bank, then they have like 2 weeks to balance their books, so they could just borrow that same money back at 0.25%. So let's say they lent it to you at 5%, and they borrow it back at 0.25%. They make a nice spread, and it's all money created originally on the books of the banks.
Well, this is confusing, and the public banking gets away from that to a degree. Is that correct?
Well, the idea of public banking is just that here the banks are creating money on their books. They're not lending their own money. They're not even lending their depositors money. And yet they're getting, over the course of a 30-year loan, you will pay at least as much in interest as you pay on the original loan. So the banks are purporting to be lending something of their own, but they're not. And so we, the people, could take over that function. I mean, they're only creating credit on their books, and it's backed by the full faith and credit of the United States. As we have seen when the banks collapsed, who stepped up to save them? We, the taxpayers. If we're going to be liable for the costs, for the downsides, we should get the profits. So that's the whole idea of public banking. We want to keep our revenues local, leveraging for our local purposes, and we want the profits to go back to the government to be used for all those things that people expect of government. The original model was the bank that was in Benjamin Franklin's colony of Pennsylvania in the early 18th century, where 18th, yeah, where they had a land bank where it was actually established by the Quakers in Pennsylvania. All the colonies were issuing their own money as paper scrip, but some of the colonies tended to over-issue it, and they would inflate the money supply and devalue the currency because it was easier to put it out than to pull it back in taxes. But in Pennsylvania, they lent the money, so most of it went out in the form of loans. So let's say you would print $105, you would lend $100 at 5% interest, you would spend the $5 on roads and bridges and whatever government spends on, and therefore you would have $105 out there in this circulating medium to pay back principal plus interest. So it was a sustainable system. You could lend the 100 all over again, spend the 5 all over again, you bring back 105 as principal and interest. You could do it again and again. Whereas in the system we have now, the banks create the principal, but they don't create the interest. And therefore, somewhere, somebody has to take out yet more loans in order to create the interest. So it's a pyramid scheme where the debt pyramid, there's never enough money in the system. There's never as much money as there is debt. And so the debt continually grows exponentially, and the money is trying to keep up with it. So we have this perpetual need for growth, and this just debt upon debt that ultimately is unrepayable, and that's where we are now. We're sort of at the exponential curve on this pyramid scheme.
Well,
that could be fixed with a public system where everything's returned to the center.
Now, I was a friend of the late Eustace Mullins, who wrote The Secrets of the Federal Reserve. And I would have to say that the Jekyll Island at the Federal Reserve was a result of a conspiracy. Would you argue with that or agree with that?
Well, it was certainly, if you define a conspiracy as a crime plotted by 2 or more people behind closed doors, there was definitely fraud involved, because William Jennings Bryan, for example, was the populist leader, and he originally said, absolutely not, there is no way he would approve a bill that would give the power to create money to private bankers. And when the Federal Reserve Act came, when it was written, it was so obscure, so obscurely written that nobody really knew what it said, and he thought that it did give the power to create money to the people themselves, and he celebrated and said, at last the people can issue their own money. So it was fraudulently enacted. It was enacted on December 23rd when the legislators had mostly gone home for Christmas, and it's been used. The Federal Reserve is actually the private head of the private banking system, so they're like the house where, in a big casino where they control the bet. For example, in these interest rate swaps where the Federal Reserve pushed interest rates nearly to zero, which it was a great windfall for the big derivatives banks, and it just killed the state and local governments who are on the other side of these interest rate swaps. So that you have this giant, well, there are 12, the Fed consists of 12 branches, all of which are 100% owned by the banks in their district. The largest and most powerful by far is the New York Federal Reserve, and that's where all the big derivatives banks are, and they call the shots, to benefit themselves. So we have like quantitative easing right now, where we have trillions of dollars have been printed, but for what? To serve the banks. None of that money actually makes it into the real economy to serve the state and local governments.
Well, how many times in history have they done something like this? Done a Federal Reserve type act?
That's pretty unique in history, but the whole central banking system pretty much started at around that time. I mean, of course, we had the Bank of England that goes back to 1694, which was a private central bank that issued the money of England and charged interest to the government for this benefit. But and then you had your your colonies, your various British colonies, which then broke away, and it was the king who told the American colonists that they couldn't issue their own money, and Australia formed its own central bank that issued its own credit, and actually funded World War I, their participation in World War I, without borrowing from the Bank of England. Well, the way the British were keeping control of their colonies that were now independent was through financing. And so in order to regain control, they established this central banking system where originally their plan was to have all these countries, the central bank would issue the money and lend it to the government, and at the head of the apex of the pyramid was to be the Bank of England. But after World War I, they didn't have the resources, and so they joined up with 3 other big bankers and formed the Bank for International Settlements, which then became the head of this central banking system. But it's still a privately run central banking system, run for the benefit of the banks, for maintaining the stability of the banks. It's not run for the people, and they don't think much of government. They try to be independent of government.
Well, okay, so banks fundamentally, I don't know how to put it, but they don't tell the truth. That would be a very mild statement, wouldn't it? What about gold? We went off the gold standard in, what was it, 1970? Nixon took us off the gold standard, is that correct?
In 1971, that's correct. And what about it?
Well, the banking wasn't running then by this credit system that you've described up before 1971.
Well, it was. After 1933, domestically, that's the way the U.S. system ran. We didn't have gold backing the dollar domestically. Gold was only used internationally to clear trade balances. And then de Gaulle decided to cash in all his dollars for gold, and that took something like a third of our gold supply. And then England tried to do the same thing, and that's when Nixon said, sorry, that's going to break us if we allow we obviously had way more dollars out there than we had gold to cover them. So after 1971, then the dollar started a nosedive, and to save it, according to Bill Engdahl in one of his books, and he has good references for this, in 1973, Henry Kissinger met with some big bankers in Sweden, and they decided that they would back the dollar with oil. And then Kissinger and Nixon, I think, met with the Shah of Iran, and it was agreed that the OPEC countries would sell their oil only in dollars and that they would put their dollars in U.S. banks. So this recapitalized the U.S. banks, or refunded them, and it meant that all these countries that formerly thought they had enough reserves for their oil needs had to borrow. So they had to borrow from our banks. That put them in debt to our banks, and they have remained in debt, or they've been in this debt trap ever since.
What country has public banking?
40% of banks globally are publicly owned. These are largely in the BRIC countries, Brazil, Russia, India, and China, which also have 40% of the global population. And they all escaped the credit crisis. They've been growing like gangbusters. China has grown by 10% a year for 30 years. I mean, they're slowing up now, but they did grow at this phenomenal rate. Korea did the same thing. And the way they did it was that they owned the banks. They guided, it was called credit guidance, where they allowed banks to create credit, but only for purposes of serving the economy, not for speculation, not for the bank's own account.
Well, that's fascinating. I didn't know that about the BRIC countries, of course.
That's
Don't know
all
a
in my
lot.
book, The Public Bank Solution.
Okay. Do you know how Japan is about Japanese banks?
Yeah. Well, they have a debt that's 225% of GDP, and they still keep tooling right along. Why is that? Because their debt is to themselves. It's one of their biggest creditors is that their public, their postal bank, which is where all the people park their savings.
So they owe 220%, is that right? But they owe it to themselves.
Yeah. But it doesn't seem to be hurting them because they owe it to themselves. They don't have any creditors who are demanding higher interest rates, unlike the small European countries. When they go under, they wind up, like Greece, I think, was paying 30% interest at one time.
Wow. Now, you've heard of the gold and hiding?
I have.
Yeah. What do you think of that?
Well, I've seen the paperwork, and I think the agreement. I think it's probably true. I think the paperwork's valid, but the problem is there's a 4-year statute of limitations on a written contract. I don't see how they can collect on it.
Is that a 4-year? I mean, this is international, so.
Well, there must be some statute of limitations in any country.
Okay.
And that was supposedly all the way back with the. Anyway, they're decades old. It's 1960s, perhaps.
Yeah, Marcos.
Yeah, when was Marcos?
I don't know. I think it's about that time. So you would say that the main issue there is the age of the contracts. They're no longer enforceable.
Well, and the fact that they've been presented to the banks, and the banks say, we don't know anything about that, that's before our time, we don't, we're not liable for that, and I don't know how you would collect on those claims.
Right, okay. Well, do you think gold has any place in the future, in our future? I mean, we'd all like a few metric tons, I'm sure, but...
Well, it's the type of thing, it hasn't been going up. I mean, it's gone way down lately. It hasn't been going up. So it's not like you hold it as a hot investment, although it was a hot investment at one time. But what you might hold it for is that it's something you can carry around. In other words, like if you had to flee to another country, you could take it with you, and it would be recognized as valuable in the other country. So it's good for fallback. I read that in Argentina, when the currency collapsed, there was one woman said her family had a few gold coins, and one gold coin a month was enough to sustain them. So they used those, I think, for a year, and then the economy got a little better, and they were able to make money again.
There's this term, goal backwardation. Can you tell us something about that?
No, sorry, it's not my. I mean, I've certainly heard the term, but I'm not an expert in it.
I think it means something to the effect that the current price of gold is always less than the future price of gold. And I don't understand it any more than that. Well, I don't understand it. Okay. Well, why should we vote for you?
If elected, I will get a fire under the legislature to proceed with this bill for a state-owned bank, which got quite far. It passed both houses of the legislature for a feasibility study to look into it. And how I would fund it is that the treasurer manages an investment pool currently containing $54 billion, which is invested at 0.24% interest, almost nothing, and take some of that money and invest it. It can't be spent, but because it belongs to different agencies, but it could be invested as capital in a bank and then run the state's revenues through it, just as Bank of North Dakota does, and their payroll and their all the monies that they have can be run through this bank, giving it a huge capital base and a huge deposit base, and you leverage that into credit for the state, as North Dakota does.
Okay. How can we support you in this campaign?
My website is ellenbrownfortreasurer.org, so that's the number 4, and there is a donation page there or a volunteer page, and then my regular website is ellenbrown.com.
Okay.
And my books are on Amazon.
Okay. So all of those, all of the
Sure.
above.
And my regular website, ellenbrown.com, that's my blog, and it has over 200 articles on it, so you can learn all about these issues.
Yeah. Well, very impressive. So we want to wish you well in your campaign, because sounds like might keep us afloat.
Okay, thank you very much.
Thank you.